What's going on, Sats fans? Welcome back to Swan Signal Live. I'm your host, Brady Swenson. I'm here with my boys, Brandon and John. Steven is in absentia at the moment. He's on a very important call, more important than Swan Signal Live. That's okay. He'll be here soon. We'll get started with these guys today, and then we'll bring in the big star of the show here to dunk all over the place. Brandon, how's it going, man?
Oh man, doing great. Busy week. Feels like it's been 2 weeks already this week. Longest year ever.
Starting off with a lot of work.
A lot of work, and it's only 10 days into the new year, and it feels like we've lived through a decade.
Wow, man. Good luck with that. We'll make it through. John, how's it going, man?
Good. Yeah, Steven better have some major breaking announcement. If he's going to be late for Swan Signal because he's on a phone call, it's got to be a major breaking. That's how I hope he enters here. We'll see.
Major breaking. Steven Lubka buys more Bitcoin. There he is. What's going on?
Oh, there he is.
What's up, guys? Sorry, there's just too much Bitcoin to sell today. We got too much demand from clients, but yeah, thanks for bearing with me a little bit.
No worries, buddy.
Wow, what's that weird thing on your
know. I had to come off an important meeting here. I can't wear a tank top all the time, unfortunately. So I'm out of my usual attire.
You look good, buddy.
The fans are not going to have that.
There's a collar on that shirt. Wow.
I know, dude. You need to be consistent. Like, things are about consistency.
All right, tell us in the chat. Do you prefer tank top, Steven, or collared, Steven? Let's find out. Thanks, real quick. Thanks to Mara for supporting the show. Mara is securing the Bitcoin network while supporting this show as well. So shout out to them. I think they're the largest public miner out there. So doing good things for securing the Bitcoin network. All right, guys, we've got a lot to jump into today. Today is the day of the first Bitcoin transaction, the anniversary of the day of the first Bitcoin transaction. Satoshi sent Hal Finney 10 Bitcoins on January 10th, 2009. Two absolute legends, obviously. Satoshi's there. Everyone knows Satoshi's name. Pretty much everyone who's heard Bitcoin has heard about the Satoshi legend as well. Not everyone's heard about Hal Finney. He is, in my mind, equally a legend, right up there with Satoshi. His life was spent very well. Part of the cypherpunk mailing list, an accomplished coder. And man, that guy had some insane thighs and calves. Seriously, a very fit man, and ended his life, tragically in a wheelchair. But his legend lives on and endures, and we will mention him every January 10th for the rest of my life. So shout out to Hal Finney.
Yeah, a little more Bitcoin history. I mean, this is related to what Brady said, that the tweet running Bitcoin was January 10th. But then 1 year ago is the day that Bitcoin ETFs were approved. And do you guys remember that there was that whole mess up with like the announcement got posted by the SEC for the approval. And then
That's
they were
right.
like, no, wait, that wasn't it. But someone might have just hit, send too early, because I think it was only 24 hours later that they actually did approve it. And then they launched, I think, the next day. So that was like a crazy 48 hours, exactly 1 year ago.
There's a criminal case for that. Do you know that?
I did not know that.
Yeah, they're taking someone to court for that exact. They hacked it apparently.
Is it an 18-year-old or a 16-year-old in Florida or something?
It's some kid. Yeah, I think it was Florida. It's some kid that just did it. By the way, shout out to everybody for preferring the tank top. We were like 4 for 4 on this, and I agree.
Yeah, there we go. It's the tank. It's also a hell of a house plant, apparently. I don't think it's a house plant. Is that in the backyard?
I'm outside, yeah. Like, you got to be sun maxing at all times. I don't stop for a mere podcast.
All right, sun maxing indeed. God, I miss the sun. It's been gone for like a long week for me. 2 feet of snow and clouds. Boy, man, I had a long hot run in the gym today. That felt good.
Yeah.
What do we got on the docket today, guys? John, I think we're going to kick off with some macro stuff as we have been the last few episodes. So why don't you tee it up for us?
Yeah, so I'll preface this by saying we're going to talk a little bit about a economic data release that came out today. We're going to talk about intraday price moves. And I don't want anyone to think that, like, don't take this too seriously. in my old career, I kind of grew to hate the people on Wall Street that overanalyze the intraday price moves on the back of one data release. Like, these are things that a few days from now, they will probably be out of date, right? Talking about intraday price moves is not like a evergreen long-term piece of content that you can look at. But the reason I want to mention it is just because at 8:30 we got jobs data. Typically, big data releases come out at 8:30 in the morning Eastern time, and you can typically see what interest rates do because stocks are not open at 8:30. You can look at what futures do, but the indices themselves are not open. You can look at what Bitcoin does at 8:30, and it's actually kind of interesting because at 8:30 Bitcoin drops pretty quickly, and that was on the back of more jobs added in that data release than people expected. And this is one of these classic things, really ever since the financial crisis. It's this idea of good news is good news for the economy. What looks like good news is bad news for asset prices, because the good news means the Fed isn't going to cut as much, and therefore asset prices aren't going to pump as much. That's like the super oversimplified view here. But as the day has gone on, Bitcoin kind of dropped pretty quickly at 8:30 in the morning, and then it like chopped around a little bit. It's low, and then later in the day it started to rally again. But what's interesting is that stocks have stayed low that whole time. So, what to make of this? It's a little speculative. We don't know what's causing Bitcoin to move in any given hour. But I would say the kind of two potential explanations are: one, there's a large buyer in the market that doesn't really care about what the jobs data said today. And they're just saying, hey, we're buying Bitcoin, so that's pushing the price up. Obviously, that would have to be someone buying in size. The other explanation could be if people are reading through the fact that inflation might be stickier than people think. But this kind of gets back to the whole macro thesis of the Fed and the government at large is caught between a rock and a hard place. And they're eventually going to have to just let inflation run somewhat hot to a certain extent. And if that happens, that's typically going to be good for Bitcoin and financial asset prices. So there's a ton we could dig into there, but that's kind of an opening macro summary.
It's so funny because we're in this moment where like the economy is doing too well, so you need to sell all the equities. Like, come on, this is where this over indexing to like the Fed reaction function is just wild. Where so a few things here. The market is now basically pricing no cuts or one cut for 2025. So when we started November or whatever, there were 7 cuts priced for 2025. We're now down to 1. And the S&P is down about 5% and Bitcoin's down a little bit. But what you can say there is the market has almost entirely priced out the cuts. Now, if you're me, what has to happen here in 10 days? Trump is coming into office. Scott Bessent is coming into the Treasury. You've got the 30-year bond at 5%. You've got the 10-year way too high. And you've got the dollar index at like 110. These are unworkable numbers for the incoming administration. So what do they need to do? They need to get the long end of the bond curve down. That 30-year needs to come down a lot. And the way they can do that is with the Fed. And so I think there's going to be an immediate political pressure to cut, to bring the long end of that curve down, or some other sort of intervention.
It's already started, Stephen. The political pressure has already started.
Like there's no conceivable way. So if the market is saying we don't see any cuts, I would say you should almost be certain there are more cuts than that coming. So it's honestly like not a bad foundation to be starting the year at, especially because like the yields and the cuts, those are political objectives. Like those can be managed politically. If the economy was falling off a cliff, that's a lot harder to manage politically. So I'd rather have there's too many jobs and the economy's too hot, then, and we have to deal with yields and we have to deal with the dollar, then like the economy is crashing into a recession and yields are low. Like I honestly think, even though I think markets are panicking on this a little bit, it's a nice setup. And, to John's final point, Like, and then you have Bitcoin rallying. Why is Bitcoin rallying? Well, A, maybe people understand that. And B, the setup is just so structurally bullish for Bitcoin coming into this next year. It's like, what? You're going to be in cash. And then what? Trump announces some version of the SBR in 7 days and you're caught on the sidelines. Like, you just can't risk being really in cash here on Bitcoin.
And if you are a believer in the fiscal dominance, nothing stops this train thesis, part of that thesis is that 25, 50, even 75 basis point cuts or hikes on the other end by the Fed don't have as big of an impact as maybe they did historically. So I think that's also part of what you're kind of saying here, Stephen, is that, okay, if there's an extra cut in there, 25 basis points, that's not really what's driving markets right now. It might be in the short term because people are so used to that reaction function, but the environment we're in, it's not actually leading to that big of a change as people might expect it to.
100%. Let me just follow up there real quick. And also, like something Sean just said in the comments, is the market telling us the Fed is losing rate control ability? And to John's point and to Sean's, like, yeah, I think the Fed has kind of lost control of the bond curve, right? Because what I mean by that, let me explain that. So they've been cutting, like we've been in a cutting cycle. They have cut interest rates several times, and rates are basically higher than when it started. So the Fed has been ineffective at bringing these down. So there's two things that have broken. One, they've been ineffective at controlling rates. But two, bonds are down and stocks are down. People noticed in COVID that the relationship between bonds and equities completely broke, right? It used to be, you know, if stocks were up, bonds were down. If stocks were down, bonds were up. There was like a hedging sort of component, and that was the 60-40 portfolio, and that was the Bridgewater, Ray Dalio all-weather portfolio. And then in COVID, this pretty much like breaks down. And we're now here again, right? So, you know, stocks have been doing fine 2023 and 2024, but this last kind of 3 or 4 week window, we're having bonds being sold off constantly. That's driving rates up. You're also having stocks falling. And so it's this environment where like the normal environment is gone. It's like a uni market. It's just there's only one market. It's either stocks are up or they're down, and there's nowhere else to hide. And this is breakage. This is something breaking.
Brandon, do you have any thoughts there?
Stay humble, stack sats.
Yeah. Ignore everything Steven just said. There's one thing you need to do. In fact, you can just stop watching the show, never watch it again, and just stack sats and stay humble. You'll be fine. This does make it.
Hold on, summary.
Yeah,
What I'm hearing is it's all vibes. So get with the vibes. And if the market is pricing in no rate hikes next year or rate declines next year, and we get some, then it's just going to overly pump because of that. And I think it's fair to assume that Trump wants that. Historically, he's always wanted to win, and he'll take the long-term pain in order to juice the economy. So.
Yeah, I mean, he did say very clearly that he thinks the Fed needs to cut at his last press conference, which, you know, we're back in a world of Trump press conferences, and they're always entertaining. that one was very interesting for lots of reasons. But he did say that. We do have a piece dropped this week by Lynn and Sam Callahan, who is a former Swan and a good friend of ours. Let's see. Oh, we got those are the ETFs. There we go. So she finally had Sam helped her kind of pull all of this together. She's been talking about nothing stops this train and fiscal dominance for a long time. And she put it into this piece again, she and Sam. I think it's fantastic. Let me pull up the actual piece itself if I can. Yeah, here we go. Full steam ahead, all aboard fiscal dominance. This is basically the cycle here. You have higher interest rates, higher interest expense goes to, and refinancing costs leads to larger fiscal deficits, which leads to more money printing like QE and direct monetization, which then leads to sustained inflationary pressure and then higher interest rates. And basically it's, the ability for the Fed to impact the economy with the tools it has, money printing and rate cuts primarily, and QE, et cetera, as she mentions here, different kind of money printing approaches, is not anymore the dominant way to affect the economy, right? They're losing their power because of fiscal dominance. Fiscal dominance is now driving Fed policy, and that's what she's talking about here. If you take a look at the debts, the public debt growth with fixed interest rate scenarios. So this is rates at 2, 3, 4, and 5%, looking from 2024 to 2034. So 10 years out, we're looking at $45 trillion public debt growth, and that's it's proves the point here. So guys, did you have a chance to take a look at this report? I know she's been talking about this subject for a long time, so the premise is out there already.
I mean, it's been a key topic, and it's one reason I think so many investors got the 2023 market wrong. I mean, this is kind of in the rear view window, and I see John nodding his head. But like, if you were here for 2023, the Fed had just been like hiking rates, and you had a bad year in 22, but rates are staying high, inflation's still hot. And so everyone's bearish and everyone's calling for a recession and everyone thinks like these rates are going to crack everything. And then what happens is you have like from mid 2023 to the end of 2024. I mean, was that like the best 1.5 year S&P performance of all time or something close to that, right? Like it just is a raging bull market while everyone's on the sidelines because of these high rates. And I think it broke people's brain. And I think it's a similar thing to this. Like, why was that? It's this fiscal story. It's the Fed is just not there.
I mean, it's interesting too. There's having some fiscal discipline is one way that you could work your way out of this, and it would take some time, obviously. But the problem here is that only 14% of the budget is actually discretionary. 87% is paying on interest, and mandatory programs like Social Security, military spending, etc. So it's the Congress really only has fiscal control over a small percentage of the federal government's budget. So there's just not much it can do, and that's why nothing stops this train, right? So what are the implications then, John? I mean, if this is just the path that we're on and there's really no action to get away from it in the long term, there might be some short-term fixes here and there. But what does this mean in the long term for the United States and for the world?
Yeah, simple question. No, I mean, I think from an investment perspective, it means that there could be, nothing goes up in a straight line, of course, but generally speaking, financial assets are much more inclined. I'm talking US financial assets here to increase. Some people like the term melt up because it kind of highlights the fact that, okay, these asset prices are going up. It's not necessarily because someone invented some amazing new service, because their earnings are better. It's like increased liquidity because the system needs increased liquidity, and eventually it's going to get it. Again, you can have short periods of time where things don't look good because there's some idiosyncratic thing going on. You can have a year like 2022 where things turn around, but to go the other direction. But to Steven's point, look at what happened in 2023. There were so many people that were huge macro bears in 2023. I wouldn't put myself in the category of like being a huge bear in 2023, but I did not think it was going to be as good of a year for investable assets in 2023 as it was. Like I thought it was going to take longer to recover those 2021 highs. So that surprised me a ton. I have to admit that. Another example I would point to is March of 2023. Things can go wrong in the system. Things can break in the system, like the banking system. Silicon Valley Bank, First Republic Bank. But what people need to remember is that the Fed, the Treasury, the FDIC, they've become very good and fast at responding to these things. It's not 2008 where there's like months of Senate hearings where they debate, should we bail out this or not bail out this out? Like it happens much more quickly now. So my base case is that there could be things that go wrong, but you have to ask yourself, is the incoming administration going to allow some situation where interest rates go to 6% on the 10-year on a sustained basis, and the stock market is down 30% for months and months and months. Do you think Donald Trump is going to allow that? That should not be your base case.
Exactly.
If I were going to try to play the other side of it, the only situation I could see is where it actually happens. Rates go crazy and the stocks are down for a prolonged period of time, is like some insane geopolitical event that we can't even predict what it is. But even then, it's like you probably get more liquidity on the back of it. The other way would be like if there's truly forces within the government that are trying to stop Trump and all his appointees from actually accomplishing things. And I know I'm being vague there because I'm just trying to play the other side of it. But again, my base case is that the new administration and all of his appointees are very, very inclined to see positive financial asset performance as soon as they take office.
Yeah, 100%. 100%. Like there's just no, and it's like it's asset performance, and it's also the fundamental functioning of the treasury system, right? Like it's even more like Scott Besson is not going to come on and be like, yeah, I guess like bonds are just going to get relentlessly sold off for the next year nonstop and no one's going to buy them. Like bullshit.
I mean, another piece of the puzzle here is demand for US dollars. I know you posted about the DXY earlier this morning, Stephen, but how it's just sky high right now.
Yeah, let me see where it's at right now.
So there's going to continue to be persistent demand for dollars and debt based in dollars.
Yeah.
And so fiscal dominance will continue, right? Because of that, right? The dollar is going to continue going up and become more powerful. Therefore, fiscal dominance, it's hard in that environment. It's hard for fiscal dominance to, go away or be lessened. So there's just a lot of factors pointing to nothing stops this train. And it's the world we're in.
Yeah.
So
it's DXY, the dollar index, is basically just shy of 110 right now. I mean, these are huge problem levels, not just for the US, but for other countries, for their debt levels, for what it costs to service their debt. So, I mean, like everything needs to come down from here. When I say everything, I mean yields and I mean the dollar index, or things start to break.
There's one point related to this that I'd like to make, and I think Luke Groman is the one who said this. I've consumed so much content, sometimes it's hard for me to remember where I heard it. I think it was Luke. You need to distinguish between increasing dollar usage across the globe versus the value of the dollar measured by DXY going up.
Totally.
Like you need to remember those are two different things. And generally speaking, Trump, really any administration on either side, Treasury Secretary, they want dollar usage to increase for sure across the globe. Like they want the dollar to be entrenched in terms of usage. They don't necessarily want the Dixie to go through the roof. And if you look at what the Dixie did during Trump's administration the first time, it pretty quickly got weakened when his administration got in. People have been overlaying those charts and kind of implying like, hey guys, this is likely to happen again. So just always remember to distinguish those two things about the dollar.
Dude, there would be a great, like if you had a similar show to ours, but it was for women and it was about traditional finance, you could call it the Dixie Chicks. That'd be really that'd be fire.
I mean, you could be the Dixie Dudes.
Marianne and Wanda were the best of friends all through their high school days. Isn't that an argument for the stablecoins, essentially? Like proliferate dollars everywhere and buy treasuries on the back end?
Yeah, it is. That's honestly true. Like, you need, like, there's not enough buyers on these treasuries right now. If there were more buyers, those rates would come down. That's just how the market works. Like, people are selling treasuries and someone needs to start buying them.
Agree. Obvious on the back end. What about on the front end using the dollars? Does that differentiate how Luke Roman was meaning it, John?
You're saying does stablecoins meet his dollar usage part of the argument?
Yes.
Yeah. I think he's basically saying most of the powers that be in the government, they want to stablecoins are okay with them. That's increasing dollar usage. Whether or not the dollar goes up, is strengthened or weakened relative to other currencies, separate topic.
Separate. Yep.
Yeah.
So I would then, in this environment, we would expect the Trump administration to roll out the red carpet for stablecoins.
Yeah. I haven't looked, and I'm sure there's someone out there who's like, gathered all the quotes of what has Scott Bessent said about stablecoins, what has Vance and other people said. I'm not sure off the top of my head, but in general, I don't see them having a big reason to oppose stablecoin adoption. Oh, like Lutnick and other, I think all these guys they're okay with stablecoin adoption.
John has to take off here in just a little bit to go educate the masses on Bloomberg. So let's take a look at this other topic you wanted to cover before you have to take off. So yeah, here's a list of, this is ETF performance last year.
The Bitcoin ETFs are highlighted in orange. Good choice of color, James Seyfert, I think he's the one who put this together. Plus, it looks like Bloomberg data. He's one of the guys at Bloomberg. Just eye-popping numbers here, right? There's 4 Bitcoin ETFs here. Everything in white is some other industry sector ETF, and what it's showing is it tells you the launch date. It tells you the assets that they have accumulated in millions. So that's 52 billion for IBIT that they accumulated at the 1 year mark. So QQQ, probably one of the most famous ETFs in the whole world, that accumulated 18 billion in 1 year. And it's good that they have the inflation adjustment, right? Because dollars have not retained the same value, 1999 compared to now. But even inflation adjusted, IBIT has grown, much more quickly than QQQ. And again, there's 4 ETFs here that essentially do the same thing. Like, you could kind of aggregate these numbers and put it into one, because that's people all getting exposure to the same thing. And most people don't even really talk about ARKB and BitB. But look at those. They're in the top, whatever this is, 15 ETFs to accumulate assets in their first year.
And
so
by far too.
Yeah.
So
it's just, smashing
QQQ is
success.
an index fund, right? It's an index fund, is S&P 500. That's SPY. What is included in the QQQ?
QQQ is NASDAQ tech companies. Yeah, I don't think it's the entire NASDAQ, but I think it's like larger companies in the NASDAQ.
So this year, 52 billion for the iShares, for the biggest Bitcoin ETF, and just 18 for QQQ, which is previously the biggest ETF, right? So,
and if you inflation adjust it, you could say QQQ was 34 billion, but still, not even IBIT blows it out of the water.
And if you're just looking at 2024 dollars, the top 2 are Bitcoin ETFs, iShares, IBIT, and Fidelity's ETF.
Right.
So these are just massive numbers, massive demand, massive just confirmation from the market that this is an asset that has upside for the long term as well, because these accumulations have happened in market where it wasn't completely sure that there was a bull market coming, right? I mean, there was a lot of obviously positive sentiment, but what might happen this year when the animal spirits get flowing will be very interesting to see indeed. This chart at the end of 2025. Awesome. All right, John, if you need to take off, man, I don't want you to be too rushed. Please feel free to whenever you need to.
Okay. Given that we're pivoting to another topic or graphic here, I will sign off. So anyone who listens to Bloomberg Radio, you might catch me there. Guys, good to chat for a little bit.
You got to orange pill him, man. You're going to Bloomberg. You got to orange pill him. So Godspeed.
I will do that. I've listened to Bloomberg Radio myself over the years, so being on it is kind of cool for myself too. So I'm pumped.
Yeah,
awesome, man.
All right, guys. See ya.
You love it when you get your Bitcoin maxi friends onto Bloomberg Radio, right? I mean, he got himself on there, but you just love to see it.
Yeah. I'm still working on trying to extract the Sailor Party wristband by breaking this so I can save it. I don't know if I'm the only person, but
oh yeah, I just went ahead and cut mine.
I know I'm being too particular with it. I'm like these will be collectible. I feel like this will be
memento
one day, so I need to extract it appropriately.
That would be preferred for sure. All right, let's take a look. This sparked a bit of a debate in our group chat. So let's take a look at Muhammad Al-Arian on Morning Joe. Not Morning. I keep saying Morning Joe because it's Joe Kern. He's the one I tune in for. He's the one I tune in for on Squawk Box. Here we go.
They're nodding with you because we can deflate our way out of some of the step, but the difference between 2% and 3% compounded for the dollar is devastating. And I don't know, for you to just blow it off is a little weird. I mean, there's a reason they want 2%. Anyone can move goalposts. I mean, if you compound 3%, that's 50% higher than 2%.
Do you know where 2% comes from?
No, but
2%
3%, it would be, would make all of us feel awful in 10 years.
2% comes from the Bank of New Zealand in the early 90s.
It seems like a good number to me.
But it's an arbitrary number. What you've got to take into...
5 is an arbitrary number. If you want to deflate 36 trillion, let's go to 10 then.
I don't want to pull the rug from under U.S. economic exceptionalism. I think we are outpacing the rest of the world.
We're starting to at 3%.
I think we are investing in the economies of tomorrow, in the growth drivers of tomorrow. If we not
government?
No,
some of the step, but the difference.
All right.
So,
Joe, quiet, Joe. Here we go.
So, I thought this was interesting. We had a little bit of a back and forth with this. So, and I think this is a little bit of a nuanced point. I actually obviously my heart is with Joe, right? You don't want to have 3% be the inflation target, right? That does end up being, it's a drag. I mean, right? We're here with Bitcoin because we think that, inflation is fundamentally a drag on people and systems. But it's also the fiat system at this stage has to make decisions given the weight of what it's already under, right? And if the Fed would have to raise rates to 6% to hit that 2% inflation target, then I'm with the guest here. I always mess up his name. I'm with the guest that
Al-Arian.
Al-Arian, yeah.
Al-Arian, yeah, he's a famous economist.
I know him.
Yep. Yeah, I know you know him, but just for the audience, yeah, very well-respected economist.
Yeah, it's just interesting because you do that, you do crash things. He's not wrong per se. We're in this runaway train, and if you stop debasing it, the whole thing crashes and burns, right? So he's. I don't want to I don't want to kind of brush his point off too much because it's real. What you need though is you need something deeper. You need a more systems level change. It's not about can we use fiat levers to get the inflation rate down to 2%. We need something else.
Yeah, the idea of a target started in New Zealand, 1989. Yeah. The managers of the governors of the Federal Reserve, the Reserve Bank in New Zealand went out to dinner. They're like, hey, we should have a target, right? So we can tell the people what we're working toward and kind of evaluate our work, right? And so they set it at 2%. I think it wasn't completely arbitrary. I think it was set low enough so that there wouldn't be inflation felt immediately. It would be gradually over time. In fact, at 3%, 2% inflation rate, it takes about 35 years for your money value to cut in half, right? So that's about the extent of one human's career time, maybe 40, 45 years, something like that, or 2 generations of people. So it's kind of slow as we experience time, okay? And if you go to 3%, it comes all the way down to 23 and a half years. You're going to start feeling that much faster. 4%, I didn't calculate, but is going to be in the teens. Yeah. So these are not arbitrary numbers. They're you could have set it at 10%. That would be arbitrary and probably way too high. So 2% was the target rate. This is Keynesian economics. It's okay, we're going to live with inflation and debt-based money, and that's the goal here. It's not to let it run away from us. We're going to target 2%. The United States didn't actually have a 2% target until 2012. Ben Bernanke actually implemented the 2% target officially, the Federal Reserve. So this is a very new thing. It's only 12 years old at this point for the United States to have this target. So something that's interesting to me is once you set that target, it's difficult to move the goalposts. It's difficult to switch the target, because then you're like, okay, well, you guys didn't know what you were doing then, and you aren't able to do your job. Your job is to keep it at 2%. So that's probably why there wasn't a target until 2012. I think the target was set in 2012 to provide some confidence to the markets, and this is our long-term target, and here's some stability in what you can expect from Fed rate policy, etc. So I think that the intention there was good. But just 12 years later, starting to trial balloon the idea of let's go to 2.5%, 3%. If you watch the full clip, which is on YouTube, and I'll put it in the show notes, is Alarian is saying effectively, look, we're at where we are now, and it's not bad. Economy's pretty good. So it seems that 2% may have been too low. Maybe we can go higher, right? So this is this like creep, this Keynesian inevitable creep of inflation rates going higher and higher, and then eventually hyperinflating. That's, one of the most common ways that a fiat money will just go out of existence, right? So that's what I'm reading into this. And what Joe is saying is like, look, if you can't pick a number, if you can't keep it there, then what's going to happen? You're going to see the value of people's hard-earned money cut in half faster and faster and faster and faster. And that's what we're looking at happening here. And what happens when you have the 1%, right, able to access that money at lower interest rates, right? And the value of the money is debasing all the time, and faster, you just get an increasing wealth inequality, which we've seen since 1970. If you look at the charts, there are other reasons for wealth inequality, but the kind of bottom line driver, in my opinion, is inflation and money printing, money debasing, right? So you end up with these massive haves and a small amount of people with massive amounts of money and a massive amount of people with small amounts of money. And we don't want to live in that world, right? By contrast, with Bitcoin, you could support a deflationary economy. And deflationary economies have been demonized, or deflation has been demonized since the Great Depression, maybe even before that, because it causes all kinds of problems for people trying to make money, for people trying to service debt, it exacerbates wealth inequality as well, and all of these things. But that is in a fiat world. Deflation in a fiat world is trouble. It's hard. It causes lots of problems for people. Deflation in a world where you have a fixed monetary policy is actually great. It helps, my money increases in value over time. I'm, incentivized to make equity investments, to think long term. Look, if you have a world where everybody has a money that allows them to invest in equity, it's kind of equity itself, right? But you can also then use it to invest in a business or a friend's business or whatever. We can all have equity, or in stocks and in real estate and all that stuff. We'll all have more money to invest in these things that only the rich right now, the fiat rich, have access to. And that's how they store their wealth. And we're all left to have our value of our money cut in half faster and faster. Sorry for the rant. Who's next?
Yeah.
One comment here. So yeah, technology in general creates leverage. Leverage creates unequal outcomes. So since the beginning of the time, if you're more intelligent or you have more resources or you have more luck, you're going to create more, way more. And then you add the stronger the technology, the longer the lever, so the more unequal the outcomes. That is the state of the world. And what do we do about that? Well, we can have increasing wealth concentration, or naturally what would occur is that the prices of goods come down because we get more efficient and better at making things. And that's effectively a way to socialize the gains of mass technological improvements, so the whole world benefits from it. The other way is you could say, that's not happening in a fiat world though, because the prices are going up and your savings getting debased. So we're really not allowing the average person to benefit from any technological wins. Now, if we switch to a Bitcoin system in that world, obviously there's no from one to the other. So skip the transition part. But for thought experiment wise, in a Bitcoin system, savings goes up, prices go down, some combination of those two. Then all of a sudden you can have sustainable technological growth, and you don't have people unable to buy eggs and burning down the cities, right? And so, yeah, more or less repeating what Brady's saying, but we want unequal outcomes. We want maximum leverage, maximum technology, but on the back end of that, we need to raise the whatever we consider the bottom socioeconomic status that we're comfortable with, which is lower prices and better savings.
I think the detail there is that the natural gains produced by real world economic growth and technology have been financially arbitraged away by money printing. Like that's the real key. Is there's some, let's say the real world gets 3% better, 4% better, 5% better every year. And absent any money printing, people would see prices and things in their environment would get that benefit. You get 3 to 5% benefit each year. But instead, what you can do in this fiat system is you can effectively, when you see kind of real world growth happening, you can essentially print more money into that growth and eat away at that gain. Eat away because you're redirecting that net productivity gain to political outcomes and to the goals and projects that whoever is directing that flow of money is pointing it towards. And that's the real misaligned incentive. I agree with Brandon that like unequal outcomes have been with us for all of human history. I'm never going to be as good as I'm not going to be as good of a basketball player as LeBron James. I'm not going to be as good a physicist as Albert Einstein. We don't live in an equal world, but there is an added over the top systemic component here where you're actually taking a natural accruing benefit away from other people.
Yeah, it redistributes some economic power. And yes, we're going to have a merit-based economy, and we're going to accrue wealth based on merit, and that's fine. But in a fiat world, all of that value gets to be retained, while the rest of us who are, storing most of our value in fiat, or maybe have, a house that we've paid a mortgage on for 30 years, and that's our retirement or something like that, right? Or 401k. These guys have so much economic power. Bitcoin will kind of, or in a deflationary economy, will kind of redistribute that power in a more fair way. I'm not saying it's going to be like socialist, right? It's still a merit-based economy, but it allows people to take some control over their lives and not continuing to be on the treadmill constantly trying to keep up.
What's interesting here, Brady, is it's actually a perversion of capitalism, because like one of the like essential components of capitalism is generally speaking, it's a win-win system. If you invent a technology or process that's really, really good, then it makes the whole of human society landscape better, and you get rich. You get rich from the contribution to the techno landscape, right? But if that's kind of the thing, is we can align incentives where your desire to get rich is effectively yoked to your ability to produce value for the market, which improves everybody's quality of life. But if that kind of net benefit gets eaten away at, you've actually perverted capitalism.
Yes.
Here. You've made capitalism not what it's supposed to be.
It's socialism for the rich. Go ahead, Brandon.
Exactly. And to make it super real, young people today are flirting with communism, calling each other comrade, hammer and sickle, like genuinely questioning whatever we call this Western liberal thing.
They're looking for a solution. That's not the solution.
Correct.
But you can't blame them for wanting to try something else.
Exactly. However, if the benefits of technology were falling down to the population, which is the natural state, then the incentive to throw away the system or feel nihilistic would go away, or at least be reduced, because their quality of life would be improving at the rate that it should.
Right.
Yeah.
Right.
Yeah. I've always like, this argument has always kind of made sense to me, and it kind of like Peter Thiel kind of goes on about this quite a bit, but like, and this has always rang true for me. look at your house like now, like take a mental picture of your house, the inside of your house, and now compare it to the inside of your house in the year 2000. It's not that different. Like the screens are thinner. You have a phone, like everything got thinner, everything got more efficient, but you had a computer, you had a fridge, you had internet, you had phone, you had all these things. It's roughly the same. Look at the inside of someone's house from the year 1910 to the year 1940, or the year 1930 to the year 1960, or something like that. And you find this like much more rapid pace of economic growth where like the very foundational fabric of people's lives changed rapidly. You suddenly have a fridge, you suddenly have air conditioning, you suddenly have, everyone can afford a car, everyone can like, this was this very tangible rate of growth that we did at one time experience. And there's this really interesting way that it got really minimized from like, basically there was computers in the 90s, and then it's just been a refinement process, but few like 0 to 1 breakthroughs. And that's a larger topic. And like, I'm not attributing that to fiat per se. Obviously there's a role, but I think, but it speaks to like, people do not wake up on a decade by decade timeline and be like, wow, generally speaking, in aggregate, my life has gotten so much better in a material component.
Yep, absolutely. People get crushed by debt. In a Bitcoin-based economy where you have an equity-based money, then everybody has equity to play with and invest and hope for the future and something to build. And with debt, we're just constantly paying interest to middlemen and banks, and we have to fight against that all the time and try to get some kind of like profit above and beyond all of that interest and debt that we owe. So it's just a completely different society. Gold, societies with a gold standard, we're probably more productive in this regard, like Steven said. Brandon, any last words?
Yeah, I got to run. I was just tying one thought together here, which is that we have a lot of zombie corporations today, meaning that they do not keep up with the hurdle rate. They are destroying shareholder value every year, but they can play fiat debt games to borrow money at essentially zero and play funny games to keep their share price afloat, right? Which is wasted capital, entirely wasted. We have people working on things they shouldn't. We have machines building things they shouldn't, et cetera. And so if we all of a sudden forced all those corporations to realize their losses, a ton of them would go out of business. We'd recycle all the capital. So that's a preamble to say, is that the symptom of the debt-based system going too far to where we just have fewer people actually trying to build something new and taking risk? In which case, if fewer risk takers are out there, then we have fewer 0 to 1 moments, like you mentioned in the Peter Thiel thesis.
Yeah.
Yep.
Yeah. I think that's right. And I mean, I think that's always been the beauty of America is we really reward the founder, the risk taker. We reward the person that tries and does this new thing. And that's kind of what's so dangerous about all these government policies that try to take away the reward from people who have done the deed, right? Like you need to incentivize those people. And it is net beneficial for everyone else in the society that those people exist and succeed. As long as those benefits from other people's risk taking don't get siphoned away.
All right. Later, guys.
See you, Brandon. Thanks, Steven. Appreciate your time. Thank you, everyone, for being here. We take this very seriously at Swan. Every single person on the Swan team is on the Bitcoin mission. We really believe that Bitcoin is one of the most important ways that we have in this world right now to improve our situation collectively across the planet. And at Swan, we take pride in helping you do that in a very, intimate way. Like we want to be part of your Bitcoin journey. We want to have access to to an expert on our team at any time. We'll answer your questions. We'll help you think through investments. We'll help you make withdrawals. We'll help you with cold storage. We'll help you get money or Bitcoin into your IRA. We do all of these things. Check out swan.com, swan.com/private if you're interested in establishing a relationship with one of our Bitcoin experts. We really pride ourselves on that service. We also have, as I mentioned, the IRA service. You can just stack sats on a recurring basis with our app. You can find that at swan.com/app, or just search Swan Bitcoin in the App Store. We also have a credit card now that is available. The credit card will be available in Q2. I'm going to pull up the image here. So live your life, build your legacy. This is the Bitcoin rewards credit card. We're really excited about this. Super simple. You don't have to do anything else except live your life, and you'll see Bitcoin stacking into your Swan account. That's it. That's all you got to do. Sign up at swan.com/card right now for priority access. We'll email you with updates as we get more specific details about the card and the program. Would love to have you test it out and check it out. One of the first in the world to have the first Bitcoin rewards card that requires no effort besides living your life to stack sats. So that's it for this week. Join us again next week. We do this every Friday, 11 a.m. Pacific, 2 p.m. Eastern, with myself, Brady, and John, and Brandon, and Steven. Thanks again for joining us. You can find the podcast version at swansignalpodcast.com, on YouTube on the Swan channel, the Swan Bitcoin channel, and on Twitter at Swan. All right, we'll see you next week. Thanks, Sats fans.